The following script was written, verified, and approved by compliance professionals. A mutual fund is an SEC-registered open-end investment company that pools investor capital to meet specific objectives like growth or income. Regulated by the Investment Company Act of 1940, the Securities Act of 1933, and the Exchange Act of 1934, these products are central to the SIE and Series 7 exams. They offer individual investors professional management and daily liquidity through a structure that avoids the prohibitive costs of direct security ownership. The Investment Company Act of 1940 is the primary regulatory statute governing mutual funds, distinguishing them from closed-end funds and unit investment trusts. The Investment Company Act of 1940 defines the open-end structure where shares are continuously issued and redeemed. Unlike closed-end funds, there is no secondary market. Transactions occur directly with the fund at the net asset value, or NAV. NAV is calculated daily by subtracting total liabilities from total assets and dividing by the number of shares outstanding. For example, a fund with $200 million in assets and $5 million in liabilities over 10 million shares has a $19.50 NAV. Under SEC Rule 22C-1, the forward pricing rule ensures investors receive the next calculated NAV, typically at the close of the business day. To be diversified under the 1940 Act, 75% of assets must follow the 5-10 rule, no more than 5% in one issuer, and no more than 10% of voting securities. The Securities Act of 1933 mandates that mutual fund shares be sold only via a current prospectus, typically filed on Form N-1A. This document discloses critical information including investment objectives, principal strategies, principal risks, fee tables, and performance history. A summary prospectus may be used to satisfy delivery requirements, provided the full version is available on the fund's website and upon request. Operationally, the Investment Company Act of 1940 requires that fund redemption proceeds must be paid to investors within 7 calendar days. Tax-wise, Subchapter M of the Internal Revenue Code allows for pass-through treatment, provided the fund distributes substantially all income and gains. This structure avoids corporate-level double taxation, allowing the character of income, such as tax-exempt municipal interest, to pass directly to the shareholder. Supervisory controls are maintained through the Investment Advisors Act of 1940, which requires fund managers to register with the SEC and adhere to fiduciary standards. Governance is further strengthened by independent boards of directors who oversee affiliated transactions, leverage limits, and compliance with the fund's objective. FINRA Rule 2341 provides jurisdictional oversight by capping aggregate sales charges at 8.5% for funds offering specific reinvestment rights. Consistent record-keeping and statutory reporting ensure that all operational thresholds, including management fees and 12b-1 distribution expenses, remain transparent. These measures ensure that the fund remains compliant with federal mandates and internal written supervisory procedures to protect investor interests. In summary, mutual funds are primary market transactions priced at NAV via forward pricing. They provide professional management and pass-through tax efficiency. Remember the 75-5-10 diversification rule and the mandatory prospectus delivery. These are critical concepts for your regulatory examinations. Visit www.financialregulationcourses.com for finance resources and professional development. Access exclusive career tools designed to help professionals advance.